Good Sunday afternoon, everyone. I hope maybe you're enjoying the Masters as I am right behind my webcam, or it's day two of or day one of Passover. I think it's also Palm Sunday. So lots going on today. I hope you're doing well. Thank you so much for watching. As always, I greatly appreciate it. If you like the videos, please give it a thumbs up on YouTube. And with that, so if you read the blog during the week, I wrote on, I think I published Monday, Wednesday, Friday, which is the normal schedule, a lot about the markets. And there was more stuff that I just couldn't add anymore. I figured the blog readers, which is normally a little shorter, would zone out and say, please stop. So I'm going to do a catch up today, and we'll talk about the markets and the economy as we do this. As always, I'm sure I will forget things. If you have questions, comments, concerns, you're always welcome to pick up the phone, send me an email, come by the office, or send me a snail mail letter. With that, lots went on this week that we know. And the big pivot was that Trump came out, cue up a chart, to know. So on Wednesday morning, the bond market was stressed. Bond market has been stressed for a couple of days to a week or so. And this is all opinion and speculation based on the evidence at hand. So the bond market was stressed, and I will share my screen. That's the S&P 500, but we're going to look at the yield on the 10-year. So the yield on the 10-year has gone up fairly well, right? 390 to, we'll call it 450. What I believe was that here, right around 440, that Scott Bessent, the Treasury Secretary, told the president that we've got some stress in the bond market, and that's going to cause some system-wide dislocations in the various sectors in the bond market. I know people think that Trump is fixated on stocks, and he may be, but the bond market's way more important, and the currency market is certainly more important. So I think that's why the president pivoted on Wednesday, because of the surge in bond yields over a 1 week period. Some people have argued that this looks like it's an inflationary bond market spike. It is not. You really need to get bonds over really 490 and 5% for me to believe this was an inflationary spike. I think it's again, speculation is that I believe foreign buyers pulled back from our auctions, number one, and I think they may have been outright selling treasury bonds, number two. That's what I believe. And that's why you've got the stress. It's not over inflation, and I don't think the tariffs will end up being inflationary. I know that's really controversial, and then you can argue with me. I'm happy to argue, but my view is the tariffs will end up not being all that inflationary because there may be some offsets on the other side. In any case, so bond yields have gone from 3.9% on the 10-year to 4.5% on the 10-year. That is a significant move in a short period of time. If it was over a period of a month or two, we wouldn't even bat an eyelash. So that's something to keep an eye on. And if you want to look as well, here's the dollar. Look at two things Donald Trump wanted coming into office. One, he wanted a weaker dollar. Well, dollar index peaked at 110. It's now 90. It's now 100. That's a huge move in the currency markets. He got what he wanted. I'm not saying I agree with how he got there. I'm just saying he got what he wanted. And then in the bond market, they do want lower interest rates. And I firmly believe the Fed is going to cut several times. I think the Fed governors they still have their idiot moron hats on, or talking about this inflationary concern, to put it politely, that isn't there. So why do I say that, and why does it annoy so many people? If the tariffs fully come to fruition, we're talking about $650 billion. That's about 2.1% of GDP growth. 2.1% of GDP, excuse me. $660 billion is a lot of money. It's a lot more money than I have. But look at this chart. This is crude oil. I keep showing this. The last year, it's down from 88 to 61. No economist, no human being on earth can tell me this chart is inflationary. Dial it back a little more. Nope, I did it the wrong way. From 94 to 66, and before that, it was like 130 to 66. Come on, guys. You can't send me emails and tell me how we're going to have this inflationary spiral. Could I be wrong? Sure. But energy and housing are the two biggest inputs into inflation. There's nothing inflationary about this chart of energy. I'm sorry. Crude oil is collapsing because of the perceived economic output drop. That is deflationary, flat out and outright. And now I'm going to probably get all over the place. What we're looking at is essentially may end up being an outright trade war with China, and that's it. Us against China. They've already said they're not going to retaliate in our 125% tariff because what's the point? When you're in an outright trade war, trade stops between the two countries. That's bad. You know how I feel about tariffs. I won't rehash and get my soapbox, but it's bad. Yes, all of you guys can email me and call me names and tell me I don't get it. China's eating our lunch. Tariffs aren't the answer. If this comes to fruition in full, China is going to, they've got real estate problems and banking problems. China could go into a modern day depression, certainly a very strong and serious recession. And as much as everybody hates China, that's not good for anyone in the world. No one. It's really bad for the Chinese. So the other day, I was talking with someone and they opined that this is all part of Trump's master plan with China, and it's the art of the deal, and there's going to be a deal coming. I would like to think that's the plan, and it's just not chaos. But right now, it's not how it's working out yet. Now, he's not going to show all his cards. I get it. But we certainly have had extreme historic volatility. And you've got a number of market participants who are concerned. There's your inflation genie. I already did interest rates. I told you about what I think of China. Here's the stock market. So let's remember a couple things. One, I thought this had the potential to get us to rally back towards the old highs by Q3. All right. And it lasted all 2 days because I said we closed below 5,500. I'm wrong. Well, 2 days later, we closed below 5,500. I was wrong. Wrong, wrong, wrong. So people say, how come you never say you're wrong? I always say when I'm wrong. I don't care. It doesn't bother me. I put a stake in the ground every day, and I'm not always going to be right, but I know where I'm going to be wrong. That's the key. It's okay to be wrong. It's not okay to stay wrong. So we had a 2-day crash. You can't argue that. Boom, boom, 10% in 2 days. If you're a bull, that flat out sucked. It was bad. Not fun to live through, regardless. And then I said this is the day where the most likely bottom was coming this day or this day. Well, it came on this day. I didn't say it was the ultimate final bottom. We're going back to new highs. I said it was a bottom, the letter A. Okay. And then on this morning, I forgot when the market started going around 1 p.m. We saw a 3-hour rally that is more than the average return of an entire year on this day. Now, I've heard people say, Trump told the people to buy stocks in the morning and that's market manipulation. I have no idea. Frankly, I saw his tweet and it didn't resonate that strongly with me, although we did our buying in the last couple of days. So it's not like I was sitting there waiting to buy a ton more. And then when the market went crazy, I'm like, holy geez. Folks, that's the biggest short covering rally. Maybe I had one like that in 2020, maybe one or two like that in 2008. But 10% rallies, one, are rare. Two, more important, they typically happen in bear markets. or challenging markets or troubling, whatever word you want to use. In '08, twice those rallies happened, October 13 and 28. The final low didn't come until March of '08. And no, I don't think this is the same case because the banks have fortress balance sheets now. So I don't think this is '08. I don't think this is '08. It's not '08. For all those who are sending me emails that I don't get it, this is '08 again. No, it's not. And it's not COVID either. COVID's pretty bad. It wasn't '08. So here's where we are today. Here's where we are today. No, wait, one more day. Yeah. Okay. Um, my thesis scenarios are now price has been met by every metric I can find. All right. We went from the all-time highs to new lows super quickly. Price objective has been met. Could we go lower? Yes. But the objective has been met. We haven't met time. This last plunge needs more time to go by. So I'm saying right now, somewhere between 4 and 8 weeks away is going to be the low that we go up from. I'm going to repeat that. 4 to 8 weeks, there's going to be a bottom, and we're going to go up from that and rally strongly in May or June and throughout the summer. But between now and then, I expect the markets to go up and down. Don't be surprised. Should I draw this? Yeah, I can draw this. I mean, we could do a lot of this. Fat fingers, sorry. We could bang all around. We could even breach 4,800. Do not be surprised if in 4 to 8 weeks, the market somewhere down here at 4,800. Entirely plausible and possible. What I've said is this bottom is your internal or high intensity low. It means that's where the most stocks went down, and that's where the most stocks made their lowest lows. It's, I gotta pause this. And how can I pause my record? All right, sorry, I'm back. That was my wife from the store who wanted to see if I needed anything. In any case, sorry. We left off on the S&P in this scenario. So again, we could be below 4,800 in 4 to 8 weeks. That would be what's called a secondary or external low, the low you rally from. And if that's the case, I think you could finish June above 5,500. And then by the end of September Q3, I think you can be back towards 6,000. And whomever I talked to a bunch of people this week, and what I did a study, let me stop sharing. I did a bunch of studies, and 80% of the studies I looked at said stocks are going to be at all-time highs in Q1 of next year, which means that we would recover this whole bear market in under a year. And 20% of the studies said that market's going lower. So 80% say new highs, 20% say bear market. So until proven otherwise, we go with the 80%. A bunch of studies looked at the next 1 to 2 months and said it's going to be really dicey and volatile, lots of ups and downs, which is kind of what I thought anyway. So it was like good reinforcement. All right, let's see. So we did that chart. We did the S&P. We did. Oh, I'm going to pull up the VIX because I keep writing about it and share that as well. I keep writing about this is the volatility in the market. This is the volatility index, the VIX. I won't go into all the wonkiness of how it's created because it will make your eyes glaze over. Bottom line is this, folks. When we're above 30 on the VIX, it makes trading and investing more difficult. 40 even more so, 50 and 60 and above, almost unbearable and impossible. And that's because the markets are pricing in these absolutely ginormous moves on a daily basis. So if you come in today and you want to buy NVIDIA, you could buy it. It opened up a little bit. And by the end of the day, you could be down 15% on your brand new position. That's because volatility is so high. This is what happens. So the consequences are so much more significant on a day-to-day and intraday basis. But when the VIX calms down, it will tell you that things are better in the markets. When the VIX bubbles up, because VIX normally goes in a straight line. It typically does not go up and then peter around. Last August, we had a one-day wonder crash, where it went from 25 to 65 in a day. That was the day the Japanese stock market imploded. But it's unusual, a VIX up here. It's now calmed down to the mid 30s. Unless we turn tail and go lower this week, I expect it to be back to 30, maybe in the 20s, if the stock market hangs in, doesn't implode at all. But the markets are trading better. In the short term, I expect the lows around 48 and change and the highs around 5,500 to be the range. We're going to bounce back and forth in this range for a while. And then we'll have a much better move later in the year. But remember, my thesis has been this first 10% decline was not about tariffs. It was about a growth scare that Wal-Mart started. And you're welcome to argue the contrary. But I would be firmly in that camp, because when the tariffs actually came out, the market collapsed, crashed, plunged. This was about growth scare. That's why I think if the tariffs somehow go away, we'll at least get back to 5,600. But the economy, look, I said this all year so far. Our thesis was that the economy would slow this year significantly. We could get to the 0 to 1% range by the end of the year. I still think that. The fact that Trump gave a 90-day reprieve, meaning recession risk goes down. The longer, and if the tariffs come to fruition, the longer the tariffs are on, the worse it probably will be if that updated plan of $660 billion comes to fruition. As the original plan was only 0.5 to 0.75% of GDP. But what happens over time with tariffs? Companies will adapt and adjust, just like the Marines. They're not going to, so they're not, if you made, I don't know, something in your house, aluminum chairs in your house, but the tariff on aluminum was 100% plus, you're going to go to metal or wood. Common sense. Corporations aren't going to sit back and say, okay, tariff me to death. So what will happen in corporate America is, you saw it last week, companies are going to remove guidance. They're going to stop telling the public what they think is going to happen going forward. And that's one of the great excuses, which I hate about Wall Street and corporate America. They take any geopolitical event, they can hide and say, well, we're not going to give guidance because we don't know. I think that's cowardice. They always kind of sort of have an idea, and they can issue 2 forecasts too, one with tariffs, one without tariffs. But expect that earnings season started, Q1 earnings season began this week. Expect the next 4 weeks to be all about companies not issuing guidance and hiding behind tariffs and geopolitical events. Okay, what else am I going to cover? Oh, so interesting. Warren Buffett and Berkshire Hathaway, for full disclosure, we own the stock. They're sitting on several $100 billion in cash. I won't be surprised if we see some companies really hurt by tariffs, where Buffett makes some one of his, incredible Buffett deals, unless the market rallies right back up again. And on that, in COVID, I thought I had stopped sharing. Good. So look what happened in COVID. This is super duper important. Market, we had the COVID crash, 35% from high to low. It was almost a straight line move. We bottomed, we rallied. This was the key day right here, April 6, 2020. After many, many rumors and innuendo and speculation, the Fed came out not with a bazooka, not with a howitzer, not with a B-1 bomber. The Fed came out with nuclear weapons on April 6th and said, no one's going to default, not in corporate America, not in individuals. We're going to backstop the world. They came out with all these new programs that they started buying junk bonds and more treasuries and more mortgage-backed bonds. And they said, we're backstopping the world. So that's why the market never came down again. What happened instead? It went straight up, right into the peak in June. Here's your peak. If the Fed does that right now, we are going to get some kind of crazy rally to, I don't know, 6,000. The Fed's not doing that now. So when markets are down sharply, like we saw here in 08 and 2020, you always have to be on guard that someone's going to say something or do something to create a vicious short covering rally like Donald Trump did here. Fed could pivot. I would highly, highly doubt it. I think instead they're going to let this play out. They're going to cut rates. They're way behind the curve. You can say I'm not nice and I'm disrespectful. I am, but I don't know what they're looking at. They are, for the smartest PhDs in history of the world and the top bankers, they keep making all these colossal mistakes. They should have cut rates last month. They should cut rates next month. Full stop. They're not going to, but they should. They should call me. I'll help them. In any case, that's what I think is happening. Finally, get rid of my cheaters. Finally, I've emailed this to clients. I've met with clients. We've done a webinar with clients. There's so many things you as individuals can do when markets are stressed. And frankly, I think any advisor who does not do this for clients is a crummy advisor. You should fire them. I don't understand how when markets go down 20%, people are not tax loss harvesting, number one. That's idiot proof. My kids are smart. They're in their teens, but everyone should tax loss harvest a taxable account now. And then Roth conversions. No better time to convert to a Roth when asset prices are down. You're converting from an IRA to a Roth, and you're going to pay the tax. That's the one consequence. But the three benefits so outweigh that, and you're converting a depreciated asset. Shooting fish in a barrel. What else? Look, adding money and risk is test your mettle, but it's a good time. If you were going to add money 25% ago, why wouldn't you add money now? And finally, I always tell people, we do it with our clients, now's the perfect time to stress test your retirement projections. If everything was rosy on February 19th and you were beating your chest and saying you're great in retirement, run the projections now when asset prices are down 20% to make sure those projections still hold water. We do it with, and clients, we reach out to you. Please don't hesitate to hop on a Zoom with me, stop by the office. I'll be happy to update or begin projections. Just to make sure it's not the day-to-day fluctuations that matter. It's the long-term plan we created, which factors in these kinds of declines. So with that, I will say, look for a volatile week in the markets, probably not as volatile as last week. I fully expect us to be active as we've been. We typically get really active around markets groping for a bottom. It's not because we're right. It's because our models get moved from A to B to C back to A pretty quickly. It's called being whipsawed. And we continue to look and look and look for the security or the sector or the stock or the bond that catches the next trend. So that's why our activity is more. But be it as it may, easy for me to say, I always feel like declines are never a time to do nothing. There's always opportunity. Upgrade the portfolio, do something financial planning wise, do something positive for your financial future. With that, again, call, email, stop by, snail mail with any questions, comments, concerns. I do greatly appreciate your time. I hope the Masters turns out great. I got my Masters hat on and I've got my British pullover on. But seriously, feel free to reach out. No question is too small. I'm always happy to answer and have a conversation. And with that, happy Sunday, happy Passover for all of us having to endure it, and happy Easter next weekend for all of you celebrating. Bye bye.